What if we're looking at a future with, say, $5,000 gold? Sounds pretty dramatic, doesn't it?
It really does.
But, could it actually happen? Maybe under a potential Trump administration.
Mm-hmm.
And what would that kind of seismic shift really tell us about the global economy's foundations?
Mm-hmm.
That's the big question we're diving into today. What's possibly driving this, and what are the potential, shockwaves?
It's definitely a question that makes you look closely at some really fundamental forces, things happening in the global financial system.
Absolutely. And to get a handle on this, we've looked through a lot of expert analysis, reports from places like Business Insider, Politico, NDTV, Invest, City AM, Reuters,
Right.
insights from Goldman Sachs, CNBC, Discovery Alert Australia, The Economic Times, SBC Goals, Fund Selector Asia, and Bloomberg too. They're all sort of touching on this intriguing, maybe even unsettling idea of gold reaching these crazy heights.
Yeah, our mission here is basically to connect the dots, try and make sense of all that info. We want to really understand how, government spending, central bank policies, global events, market psychology, how all that could realistically push gold to, well, $5,000.
Right.
And maybe more importantly, what does that kind of price explosion reveal about the underlying stability or maybe instability of the whole global financial order? We're aiming to give everyone a clear pathway through this complex landscape.
Okay, so let's start with this idea, deliberate inflation. Some experts are suggesting maybe a Trump administration might actually see some benefit in letting inflation run a bit hotter.
As a way to deal with the debt.
Yeah, exactly. To kind of erode the real value of that massive national debt. When the dollar weakens, that $36 trillion burden feels a little lighter, relatively speaking. Now, historically, what's the immediate investor reaction when a currency weakens?
Well, typically you see a move towards assets that people think hold their value better. And gold has long been the classic example, the go-to inflation hedge in that kind of situation. What's interesting, though, is how this fits with past statements. Trump himself has sort of indicated this nonchalance about debt, right? Suggesting the U.S. can just print the money.
Right, I didn't remember that.
That kind of thinking, a potential willingness to finance deficits just by, creating money, that could seriously change inflation expectations. And when those expectations rise, gold's appeal as a store of value tends to get a lot stronger.
And then you've got the whole tariff factor. Trump's obviously a big proponent.
Uh-huh.
And while the idea might be to help U.S. industries, the immediate impact of tariffs is often higher costs for imported stuff, for businesses, for consumers. Even Fed Chair Powell has admitted that really big tariffs, like those 120%, 145% levels we might see on Chinese goods in a real trade war,
Yeah.
well, they'd likely cause at least a temporary jump in inflation.
Exactly. And places like Invest.com pointed out these higher prices from tariffs just strengthen the case for holding gold. Protection against that loss of purchasing power.
Makes sense.
And if we did see a full-blown trade conflict, those eye-watering tariffs you mentioned, some analysts are even raising the specter of stagflation.
Oof, stagflation.
Yeah, rising prices and slowing growth. Historically, you look back at the 1970s, it's an uncomfortable parallel maybe, but those exact conditions fueled a huge move into gold.
That really does make sense. And it's not just about the inflation we see now, is it? It's also anticipating what the Fed might do. Trump's been pretty loud about wanting the Fed to cut interest rates, even when inflation was, above their target.
Yeah, very vocal.
So if the market starts thinking a Trump administration will push for easier money to boost growth, what does that usually mean for something like gold?
Well, lower real interest rates, that's the nominal rate minus inflation, they tend to make non-yielding assets like gold look better.
Right.
As Reuters has noted, when the return you get on safe, interest-bearing stuff goes down compared to inflation, the opportunity cost of just holding gold decreases, makes it more compelling.
This also ties into that idea maybe governments with huge debts might, lean towards policies that cause inflation, right?
Yeah.
To sort of reduce the real debt burden over time.
It's a known playbook historically.
We even heard a fund CEO suggest that devaluing the currency is a kind of favored tool for governments in that tight spot. That feeling, that perception that the government might use inflation to solve the debt problem. Well, that definitely adds to gold's appeal as a hedge, doesn't it?
It absolutely does, which suggests investors might already be looking ahead, right? Anticipating potentially higher inflation under Trump, no matter what's said about curbing it. That preemptive buying, just based on expecting the economic landscape to shift, could be a really big factor driving gold prices even before any policies actually change.
So, okay, we're seeing potential inflation pressure from, like, multiple angles.
Hmm.
Deliberate policy, tariffs, maybe anticipating looser money from the Fed. Now, let's shift gears a bit.
Yeah.
Fiscal policy.
Yeah.
Deficits, the sheer size of the national debt.
Yeah, the elephant in the room.
Trump's economic plans, whether it's more tax cuts or boosting spending, could really expand the deficit, which is already huge. We're carrying over $36 trillion in debt, more than 120% of GDP. How does this fiscal picture feed into the gold story?
Well, persistent growing deficits, they can definitely breed a sense of fiscal instability. Investors might start to worry about the government's ability to manage its finances long term. And historically, that kind of uncertainty has often pushed people towards the perceived safety of gold. It acts like a hedge against the potential fallout from too much borrowing.
And it's worth remembering, isn't it, that even before any potential new Trump plans, people were already worried about the U.S. debt path being unsustainable.
Absolutely.
Think about this. Just a 1% rise in interest rates adds something like $360 billion to our annual interest payments. That kind of math creates real vulnerability. Gold starts looking pretty attractive as a refuge against the potential U.S. credit crunch or weaker dollar if borrowing just keeps going up.
This really hits on a crucial point about U.S. Treasury bonds, their risk-free status.
Right.
Skyrocketing debt, plus a political climate that maybe doesn't prioritize fiscal discipline. Over time, that could lead to more credit rating downgrades for the U.S., maybe even stoke worries about a potential default, however unlikely that seems right now. As Invest.com highlighted, if investors start questioning Washington's commitment to fiscal responsibility, that traditional safe haven status of treasuries could wear thin. In a more extreme situation, just the possibility of the U.S. stumbling on its debt could trigger a massive surge into gold as the last resort.
We saw a concrete example with a Fitch downgrade back in 2023, didn't we? Citing fiscal worries and governance risks.
We did.
Another round of aggressive fiscal expansion under Trump could definitely amplify those worries and maybe act as a big catalyst for higher gold prices as investors look for alternatives to government debt.
What's also kind of fascinating is Trump's own past comments on debt. He's called himself the king of debt, but he's also said it's tricky and dangerous.
Mixed signals there.
Yeah, and his earlier thoughts about maybe renegotiating or discounting U.S. debt, while maybe not current policy, it did create a bit of unease. That kind of unpredictability, even just suggesting the government might handle debt unconventionally, can be enough to nudge investors towards the perceived solidity of gold.
Goldman Sachs specifically mentioned fears about high government borrowing as a key factor driving that safe haven demand for gold.
Right.
His first term saw a big jump in the national debt, and another term could mean even more Treasury bonds being issued. If bond investors start getting hesitant about absorbing all that new debt, maybe pushing yields higher, gold could really benefit from that slipping confidence in government bonds.
And their analysis even suggested, didn't it, that continued deficit growth under policy uncertainty could push gold towards $3,300 by next year. And that's assuming things stay relatively stable, not a full crisis.
Exactly.
And we also need to think about the possibility of, well, debt monetization.
You mean the Fed basically printing money to buy treasuries?
Yeah, effectively financing government deficits that way. If deficits grow a lot under Trump, and there's political pressure on the Fed to help finance that borrowing, it could be inherently bullish for gold. It increases the money supply, potentially devalues the currency. There have even been reports suggesting Trump's advisors considered just, running the presses to lower the debt. The mere suggestion of that kind of policy could seriously boost gold's appeal as a hedge against currency debasement.
Right. So traditionally, U.S. Treasuries and the dollar are the ultimate safety nets.
To go to safe havens.
But if constant overborrowing and political games start to tarnish that image, if U.S. bonds start carrying a real risk premium because of fiscal worries, gold is likely to see a surge in demand. Investors looking for an alternative port in the storm.
Okay, now let's pivot slightly to monetary policy and interest rates. Fed independence. It's been a cornerstone of U.S. financial stability for ages.
Decades, yeah.
Trump's past public criticisms of Fed Chair Jerome Powell, even suggesting he might remove him, that raised serious questions about potential political influence over monetary policy. Why is an independent Fed so critical here?
Well, an independent central bank is generally seen as key for keeping prices stable, managing inflation without politics getting in the way.
Right.
If investors think the White House is calling the shots on interest rates, not economic data, it could lead to a loss of confidence. confidence in the Fed's ability to control inflation, manage the economy. In that scenario, gold, being outside direct government control, could look a lot more attractive as a safe haven.
We saw a really clear example of that tension, didn't we? When Trump publicly disagreed with Powell about tariffs causing inflation, and when Powell wasn't hinting at rate cuts soon enough.
Yeah, I remember that clash.
Trump's reaction, threatening to remove Powell real fast, sent a jolt through the markets. UBS even warned that firing Powell would seriously damage the Fed's credibility and its ability to set rates free from political pressure. That fear, the fear of a politically swayed Fed, would almost certainly boost gold's appeal as a hedge against potentially bad monetary policy.
And Trump's consistent preference for really low interest rates is another big factor, isn't it?
Definitely.
Throughout his first term, he kept pushing for lower rates, even talked about negative rates. If he were reelected, he might appoint more, let's say, dovish people to the Fed board, people more inclined to cut rates and keep monetary policy easy. What are the likely implications of that kind of shift for gold?
Well, easier monetary policies and just the expectation of them generally tend to support gold prices.
Okay.
Like Reuters highlighted, gold doesn't pay interest, right? So it becomes relatively more attractive when rates on competing assets are low or falling. The opportunity cost of just sitting on gold goes down in a low-rate world.
This brings us back to that concept of real yields.
Yeah.
Again, the interest rate minus inflation.
Exactly.
Gold historically does well when real yields are low or even negative. So if a Trump-influenced Fed prioritized growth, maybe letting inflation run a bit hotter to achieve it, what could that mean for real yields and for gold?
In that situation, it's quite possible we'd see negative real yields. JP Morgan analysts have pointed this out. A Fed easing cycle, which might be more likely under White House pressure, has historically been bullish for gold precisely because of that inverse link with real yields. They even suggested that even if trade tensions eased up, a Fed focused on cutting rates could still push gold towards their target, which was around $2,950 at the time.
The explicit pressure from Trump for the Fed to lower rates and keep them low, that's a big market signal too.
It is.
Lower borrowing costs might give the economy a short-term boost, sure, but an artificially loose policy risks higher inflation down the road, or maybe even asset bubbles. How do markets usually read that kind of direct political pressure on the Fed?
Often, markets react to that kind of pressure by pricing in higher future inflation. The feeling that monetary policy might be aimed at short-term political wins rather than long-term stability can erode confidence in the currency's purchasing power.
Right.
And that expectation of higher inflation then drives investors towards assets like gold as protection.
Looking ahead, Fed Chair Powell's term is up in 2026. A reelected Trump would get to appoint someone else. Someone maybe more aligned with his views, potentially even someone who's talked about policies like a gold standard. How could that uncertainty about future Fed leadership affect gold?
Well, that kind of uncertainty about where monetary policy is headed can definitely add a premium to gold prices.
Yeah, makes sense.
Even the possibility of something as radical as a move towards a gold standard, which a former Trump Fed pick had actually advocated for, can inject volatility and speculation into the gold market. More generally, any Fed appointments seen as unconventional or politically driven could make investors nervous about the stability and predictability of U.S. monetary policy, and that would further boost gold's role as a hedge against that uncertainty.
We've certainly seen in the past how even just Trump's comments about the Fed have caused market swings. Remember back in 2025, just the lack of new criticism aimed at Powell was enough to give stocks a temporary lift.
Yeah, it highlighted how sensitive markets were.
So a sustained fight between the White House and the Fed could very well lead to stock sell-offs, rising bond yields, triggering a classic flight to safety trade. And gold would be a primary beneficiary. We saw that dynamic in April 2025, didn't we? Gold hitting record highs over $3,500 amidst those escalating Trump-Fed tensions. It showed that direct investor reaction to perceived instability.
Okay, now let's shift focus to the U.S. dollar itself. Unlike many past administrations that pushed a strong dollar policy.
Right, the traditional mantra.
Trump has often said he prefers a weaker dollar, to help U.S. exports. And in practice, his trade fights and his pressure on the Fed did seem to chip away at global confidence in the dollar. We saw the dollar index, the DXY, take a noticeable hit about 8% in 2025 during those periods of intense trade tension and Fed policy uncertainty.
And that weakening dollar has a direct, usually inverse relationship with the gold price in U.S. dollars, right?
Generally, yes.
Historically, a significant dollar drop, like that 8%, has often correlated with a pretty substantial gold price increase, maybe 10, 15%, various analyses show. In fact, when the dollar hit multi-year lows back in 2025, gold surged over 20%.
And it's not just the price mechanics. Trump's aggressive trade tactics, his somewhat unpredictable foreign policy, that prompted some foreign governments to rethink the dollar's dominant role as the world's reserve currency.
The reserve status itself.
Yeah, a 2025 report suggested these policies were indeed threatening the dollar's status. Some international investors, central banks, started feeling less secure holding vast amounts of dollar assets. If the dollar's privileged position starts to erode, even a little, it naturally boosts demand for alternative reserve assets, gold, other currencies. That represents a big long-term tailwind for gold prices.
We've already seen a clear trend, haven't we? Central banks worldwide diversifying reserves, buying more gold.
A very clear trend.
Geopolitical tensions under Trump, plus things like freezing Russia's dollar assets in 2022, probably sped that up, moving away from the dollar.
Goldman Sachs highlighted that a noticeable surge in central bank gold buying after 2022, nations looking for safer havens outside the U.S. dollar system. By 2024, central banks were buying, on average, over 70 tons of gold a month. And 2023 was the third year in a row with over 1,000 tons in annual central bank gold buying. That's roughly 20% of total global gold demand. This strong, sustained buying from official institutions, partly reacting to U.S. policy unpredictability, provides a really solid base that could definitely contribute to a sustained move towards that $5,000 level.
And it's not just about safety diversification, is it?
Yeah.
Trump's tariffs also made U.S. financial assets less appealing to trading partners.
Right. Less attractive.
By 2025, there were signs that central banks, sovereign wealth funds, were starting to trim their U.S. Treasury holdings and put some of that money into gold instead.
Which, of course, puts downward pressure on the dollar and upward pressure on gold. China, for instance, has a really strong incentive to rely less on the dollar if trade fights heat up again. JP Morgan strategists saw a pattern. Beijing tended to buy more gold as a hedge when anticipating more tariff risks and potential yuan devaluation.
So the potential loss of trust in the dollar, maybe from inconsistent U.S. governance, like tariffs, sanctions on allies, unpredictable diplomacy, that can also push global investors towards gold's relative stability, right, compared to any single government's currency.
Absolutely. As France's finance minister reportedly noted in 2025, Trump's aggressive tariff moves had damaged the dollar's credibility. If that credibility keeps getting questioned, especially if there are also worries about Fed independence, we could see a growing preference for gold among international investors.
In a scenario of really extreme policy uncertainty, could we even see some kind of capital flight, a gradual shift away from dollar assets towards gold, and maybe other currencies seen as safer?
It's possible. We saw some early signs of that trend in 2025. The dollar weakened against major currencies while gold hit record highs simultaneously. Investors were basically repositioning, anticipating potential instability. A diminished global role for the dollar, even a slight one, inherently implies higher gold prices because central banks and big investment funds would likely need to hold more gold in their reserves to balance out a smaller dollar allocation.
Nigel Green of De Beer Group called gold the ultimate financial insurance in these situations, didn't he? Especially with potential U.S.-China decoupling.
He did. Nations worried about U.S. sanctions or dollar inflation are increasingly seeing gold as a safer haven, and this insurance motive can create a self-feeding loop. More institutions buy gold for safety, which can weaken the dollar further, which then validates the strategy. Some analysts think this dynamic really could propel gold towards $5,000 if confidence in the U.S. dollar and treasuries keeps eroding.
Okay, let's talk about geopolitical and trade war uncertainty now. Trump's confrontational trade stance inherently creates a lot of uncertainty, doesn't it? And that kind of environment often really helps safe haven assets like gold.
Very much so. We saw it in the late 2010s. Even hints of escalating trade tensions often sent investors running to gold. Now, with the potential for an even more intense, maybe longer conflict between the U.S. and China, the stakes feel higher.
Yeah.
As one analyst put it, we're potentially watching a strategic decoupling of the world's two biggest economies in real time. Nigel Green suggested that if this trend of rising tensions continues without resolution, it could very well push gold towards that $5,000 mark.
And the impact isn't just trade, right? A Trump presidency could also increase broader global geopolitical risks, leading to those classic safe haven flows into gold.
Absolutely. We've seen it before. Geopolitical conflicts tend to make investors seek gold safety and stability. In 2025, global economic and political worries were definitely a factor in gold hitting new record highs. The prospect of a less predictable U.S. foreign policy under Trump is a significant wild card that could trigger sudden surges in safe haven buying and provide real support for much higher gold prices.
By 2025, that U.S.-China tariff war got pretty intense. Tariffs up to 145% on some Chinese goods, China hitting back with up to 125% on U.S. products.
Yeah, it was getting serious.
That all-out trade fight really shook the markets, started pulling the global economy towards a slowdown. And gold reacted, surging over 30% year-on-year as equity investors sought safety. We even saw almost $20 billion flow into gold-backed ETFs in just the first quarter of that year amid all the trade chaos.
That direct link is clear, isn't it? Tariffs create uncertainty. Uncertainty leads to massive inflows into gold. It clearly shows how Trump's trade policies can directly fuel gold's rise.
With stock markets getting choppy and economies slowing down under the weight of trade tensions, gold really stood out as one of the few remaining safe havens.
It did.
Investors, big institutions, and individuals alike increased their gold holdings when other traditional hedges, maybe bonds or the dollar, looked less reliable because of these policy risks. The longer these trade and geopolitical tensions drag on, the more gold cements its status as that safe haven of last resort. That's a crucial factor when you think about a potential rapid surge towards $5,000 in a tougher economic climate.
And Trump's return could also coincide with, or even help trigger, a U.S. recession, especially if the effects of earlier Fed rate hikes combine with new trade shocks.
Right, the timing could be critical.
JP Morgan, back in early 2025, specifically mentioned rising recession risks, higher U.S. tariffs, and persistent U.S.-China trade tensions as key drivers for gold's rally then. They even projected it could top $4,000 the following year if those risks stuck around. The clearer the picture of economic and policy uncertainty gets, the stronger the case for holding gold becomes. It's a pretty straightforward chain. Policy shocks, fear of slowdown, central banks consider easing, plus investors seek safety gold benefits.
And we shouldn't forget the element of just political uncertainty around Trump himself. A messy election outcome, periods of civil unrest. That could certainly add to the factors pushing gold higher by undermining general market confidence.
That's a valid point. We often focus on the macro stuff, but internal political instability in a major economy like the U.S. can definitely make investors nervous. And they typically react by upping their gold exposure, anticipating potential hits to the economy or the dollar's value.
Trump's known use of sanctions as a policy tool could also have unintended effects that help gold, couldn't it?
How so?
Well, if a future Trump administration ramps up sanctions or trade embargoes, especially against major oil producers or geopolitical rivals, it might push those targeted countries to trade outside the dollar system and maybe accumulate gold as an asset that's harder to sanction.
Ah, right. We've seen sanctioned countries like Russia increase their gold reserves already. If more nations worry about being cut off from the dollar system under Trump, they might shift more reserves into gold, boosting global demand and, ultimately, prices.
Finally, investor sentiment. That plays a huge role. Gold's potential path to $5,000 is heavily influenced by how much risk people perceive in the market overall.
Definitely. Sentiment drives markets.
We've seen that when there are brief moments of optimism, maybe news about trade talks starting again, gold prices can pull back temporarily.
Sure, short-term dips.
But as long as Trump's policies keep investors on edge, create uncertainty, that underlying fear trade into gold stays pretty powerful. Even a single unexpected tweet or a surprise tariff announcement can send ripples through the markets. Back in April 2025, news reports specifically highlighted growing concerns over the economic and geopolitical consequences of Trump's trade policies, as a key reason gold rallied past $3,000 an ounce. If those worries persist and even grow, it becomes easier to see why some analysts start envisioning a path to even higher levels.
Given all these overlapping factors, maybe it's not surprising that major financial institutions have been getting more bullish on gold, right? Responding to the uncertainties around a potential Trump return.
Yeah, the forecast started shifting.
Goldman Sachs, for instance, in March 2025, significantly bumped up their year-end gold target to $3,300 an ounce. They cited stronger than expected demand driven by heightened U.S. policy uncertainty, and that continued strong central bank buying. They even sketched out a scenario where gold could hit around $3,520 if those safe haven flows stayed strong. Those kinds of upward revisions from a major player like Goldman signal a growing consensus in finance that structurally higher gold prices are a real possibility in this kind of unstable policy world.
Bank of America also got more optimistic about gold. By late 2024, their projections pointed to an average gold price around $3,063 for 2025, a big jump from their earlier forecasts.
Hmm.
They specifically flagged U.S. trade policy uncertainty as key near-term support for gold, and even warned it could approach $3,500 in case of extreme policy or market stress. Their famous line, "The Fed can't print gold," really hits home when people worry about monetary and fiscal policies going off the rails.
And JP Morgan consistently kept a bullish stance on gold, seeing it moving towards $3,000 by late 2025. But in worse scenarios, they suggested gold could even top $4,000.
Right, higher targets in adverse conditions.
Amidst the 2025 trade clashes, they reportedly projected gold could pass $4,000 the following year if recession and trade conflict risks persisted. Their thinking seemed to be whether we get more disruptive policies or a Fed easing in response, both paths actually favor higher gold.
UBS Global Wealth Management initially called for $3,500 by the end of 2025, a level it actually hit earlier during that year's turmoil.
They did.
While they stressed macro factors like a potential Fed shift and dollar weakness, they also admitted political uncertainty under Trump could amplify those gains. And lots of other institutions, HSBC, Deutsche Bank, Citi, Macquarie, were also lifting their gold forecasts. Citi mentioned a potential for around $3,500 by end 2025 in a bullish case, and Macquarie saw materially bullish developments, likely for gold.
Now, about that $5,000 per ounce target. It's still above most big bank forecasts, right?
For sure. It's an outlier target.
But some respected analysts have put it out there as plausible, under sufficiently extreme conditions. Nigel Green at De Beer Group got attention for predicting gold could surge to $5,000 if the U.S.-China relationship really deteriorates badly, with no improvement in sight.
What was the thinking there?
His reasoning is basically that a full-scale decoupling of the world's two biggest economies would have huge destabilizing economic effects, triggering an unprecedented flight to safety. Some asset managers and gold analysts even draw parallels to the 1970s, that period of fiscal chaos, oil shocks, major policy errors which saw gold prices explode. They argue a similar mix of bad news under Trump, maybe a debt crisis, soaring inflation, serious geopolitical conflict could conceivably push gold into that $5,000 range.
It's also really important to watch what central banks are doing, isn't it, as a kind of validation for this generally bullish gold outlook.
Absolutely. Actions speak louder than words.
JP Morgan noted, central banks aren't done with gold yet, expecting their buying to stay strong, especially with heightened political uncertainty. This fits with the record central bank demand we've seen, which you could read as declining confidence in the dollar's long-term stability.
And Goldman Sachs factored in that heavy buying by countries like China when they upgraded their gold forecast recently. They expect strong central bank demand to keep providing a solid floor under prices. This kind of buying from sovereign players really reinforces the bullish sentiment and is a key reason why Goldman saw limited downside risk for gold, raising their expected price range into the mid-$3,000.
And the broader market mood, reflected in all those upward revisions of gold targets in early 2025, really showed a shift in expectations, didn't it?
Yeah, sentiment was clearly moving.
Each bout of instability linked to potential Trump policies seemed to make analysts nudge their gold forecasts higher. Traders definitely noticed. Activity in gold options, investor surveys, they all suggested widespread expectations for new all-time highs, maybe even overshooting consensus targets because of momentum.
And the big institutions are also explicitly warning clients about tail risk scenarios under a potential Trump administration, aren't they?
Right, those low probability, high impact events.
Things like major geopolitical conflicts, messy debt market events, for which gold is consistently recommended as a key hedge. UBS, for example, cautioned that any White House moves undermining Fed independence could hit both stocks and bonds hard, making gold and other real assets crucial protection. Bank of America's research similarly suggested that if policy tensions really escalate, gold could trade even higher than their base forecast, specifically citing policy uncertainty as a potential catalyst for an upside surprise in gold prices.
So just to sort of recap the chain of events we've been mapping out, potential Trump economic policies, expansionary fiscal bias towards easy money could lead to higher inflation, a weaker dollar, both historically good for gold.
Check.
Trade wars, geopolitical tensions drive investors away from risk, away from the dollar. Again, good for gold. And any drop in trust in institutions like the Fed or in the U.S. government's creditworthiness pushes investors towards gold's perceived safety as insurance.
Check. It seems like almost every potential policy move or crisis under a possible Trump return could amplify economic and political uncertainty. And historically, gold loves uncertainty.
We definitely saw that dynamic play out in the markets in 2025, with gold hitting new record after new record as these risks became clearer.
Right.
Many analysts don't see an immediate ceiling for gold, given this unique mix of inflation risks, geopolitical threats, and policy unpredictability. While maybe conservative forecasts put gold in the $3,000 to $4,000 range over the next couple of years, there's a wide acceptance that more extreme outcomes are definitely possible.
And should those worst-case scenarios happen, like, say, uncontrolled inflation or a major crisis of confidence in the global financial system, that $5,000 per ounce level is absolutely a figure that warrants serious consideration. In that kind of world, gold could very well become the ultimate asset for preserving wealth amid major fiscal and political turmoil.
So for you, our listener, the key takeaway here is this. The potential convergence of a Trump administration's economic policies and a world already dealing with big uncertainties creates a very real possibility of gold prices hitting unprecedented levels, maybe even that $5,000 mark.
Uh-huh.
This potential surge would likely be driven by a potent mix of factors: rising inflation worries, a weaker U.S. dollar, ongoing geopolitical tensions, and maybe an erosion of trust in traditional financial assets.
And this leads us to a really fundamental question for everyone to think about. Given these potential catalysts, how should individuals, how should institutions be reevaluating their strategies for protecting their wealth and managing risk in the coming years?
This deep dive, we hope, has given you a useful framework for thinking about this complex issue, and we definitely encourage you to keep following these evolving economic trends.
Absolutely. And based on listener feedback, we'll certainly think about exploring related topics in future deep dives.